Let us continue with question number C 4.5.6. Mr. Kapoor owns a portfolio with the following characteristic: security X, security Y, and risk-free security. Now, understand this both are measurement of risk. Sir, why there is not one measurement of risk, other standard deviation or beta? Try to understand that this particular industry or securities might be exposed to two types of risk, and both risk are measured separately. So you can even say this is beta of factor 1 and this is beta of factor 2 of one company. Is it all right? Say there is an interest rate risk, there is a political risk, and the two risks are measured separately for one particular security. And this portion is written. Security X 0.75, this is all data given. Try to understand the risk of risk-free security. It is 0. Is it all right? And return of risk-free security is 10%, which is nothing but R. It is nothing but risk-free rate of return. Is it all right? It is assumed that the security returns are generated by two-factor model. If Mr. Kapoor has 1 lakh to invest and sells a short 50,000 of security Y and purchases 1,50,000 of security X, and now short sales we have done it in derivative in portfolio management. Try to understand how much money he is having. He is having 1 lakh. Let me solve first question. He is having total 1 lakh rupees. Is it right? What he has done in security Y, he has invested negative 50,000. Negative 50,000 is he is bearish in Y by 50,000 rupees and purchases 1,50,000 rupees of security X. The total is 1 lakh. Yes, that's the total. What is the sensitivity of Mr. Kapoor's portfolio to the two factors? Is it all right? Now, should I do both factors individually? The answer is yes, because both factors are different. Is it all right? What is factor sensitivity 1? I'm talking about 1. Factor 1 of security X, it is 0.75. Security Y is 1.50. He is not having any risk-free security. Is it all right? Now, if someone tells me to find out this portfolio risk or portfolio sensitivity, I will be doing weighted average risk of this particular portfolio. Is it all right? So, what is the risk is this? What is the weight is this? All right. Of factor 1. I can easily find out the answer. 1,50,000 into 0.75. 1,12,500. And this is 75,000. So this would be 1,12,500 minus 75,000. 37,500 divided by 1 lakh, it is 0.375. 0.375. Factor sensitivity 1 of portfolio. Start. Similarly, I can find out factor sensitivity 2 of portfolio by taking this as 0.60, taking this as 1.10. This will be 90,000. This will be 55,000. This is 1,45,000 divided by 1 lakh. Factor sensitivity 2 of the portfolio is nothing but 1.45. That's correct. So this is how. Try to understand if this was beta, there would be only one answer. This is beta of two different factor of one particular security. I'm finding out answer in that manner. That's correct. So with this, question number 1 is over. Question number 2. If Mr. Kapoor borrows 1 lakh at a risk-free rate, So let me answer question number 2. In risk-free rate, he has borrowed 1 lakh rupees. Borrowed 1 lakh rupees is negative 1 lakh. At a risk-free rate and invest the amount he borrows along with the original amount of 1 lakh. So now totally he is having 2 lakhs. In security X and Y in the same proportion as described in part 1. So in part 1, what was the ratio is 3:1 in X and Y. So this 2 lakhs rupees will also be invested in the ratio of 3:1. Is it alright? So 2 lakhs in 3:1 is 1,50,000 in X and 50,000 in Y. No, is it alright? Because in Y it was a negative figure. This is 3:-1. Is it alright? It is 3:-1. So dividing 2 lakhs into the ratio of 3:-1. 2 lakh divided by 2 is 1 lakh. 1 lakh into 3 is 3 lakhs in X. Negative 1 lakh in Y. This is 3:-1 ratio. Is it between X and Y? And the same thing I'll be repeating again. Is it alright? What is the sensitivity of the portfolio to the two factors? Is it alright? So in first case, I need to write down 0.75, 1.50, 1.50 and 0. Is it alright? I need to find out sigma IW divided by sigma W. Believe me, this answer would be 1 lakh. I'm finding out 3 lakh into 2.75 is equal to M plus 1 lakh into 1.5 is equal to M minus and 0. Is it alright? This is 2 lakh 25,000. This is 75,000. It is 0.75. If I want to do with factor sensitivity 2, it is 0.60, 1.10. 0.60, 1.10 should be taken as risk. Find out sigma IW. 3 lakh into 0.60. And 1 lakh into it is 1,10,000. This is 70,000 divided by 1 lakh. It is 0.70. This is factor of sensitivity 1 of portfolio. Sensitivity of factor 1 of portfolio. Sensitivity of factor 2 of the portfolio if the portfolio is created in this manner. So these are first two questions. Third one. What is the expected return premium of factor 2? Now try to concentrate. As per CAPM model, if you understand the logic of CAPM model, what does it says? Try to concentrate. It says your expected rate of return should be equal to risk-free rate of return plus sensitivity or beta into risk premium. That is nothing but RM minus RF, which is nothing but risk premium. Risk premium and return premium is one and the same. Is it all? So I will be using the concept of this and will be formulating first for security X. What is security X? Rate of return 15%. This is for security X. What is risk-free rate of return? We know it is 10%. Plus, now I am taking factor 1 first. Is it alright? Now, if there is a 2 risk measurement, I will be taking risk premium of both the risk measurements. Is it alright? So, I will be writing risk premium for factor 1, risk premium for factor 2. Is it alright? What will be risk premium for factor 1? For security X, risk premium of factor 1 is 0.75. is it all right, into risk premium of factor 1, is it all right, plus what is the risk premium of factor 2 for security X? It is 0.60. It is 0.60 into risk premium of factor 2. Similarly, let me draw it for Y. Expected rate of return is 20%. Risk-free rate of return is 10%. Plus 1.50 risk premium of factor 1 plus 1.10 risk premium of factor. By CAPM model, yes sir, in CAPM model we do RM minus RF, agreed. If there is only one beta, beta into RM minus RF, that is nothing but a risk measurement into risk premium. Here also I am doing the same thing, but as there are two risk factor, I am adding 2 times instead of 1 time. Is it all right? Now solving this is not a very, there are 2 variables and there are 2 equations. I am directly taking the answer. The answer of risk premium 1 is a 6.67 and a risk premium 2 is a 0. Is it all right? This is what is the answer. If I solve this 2 equation, I will be getting this answer. The question asked is, what is expected return premium or risk premium of a factor 2? Risk premium or return premium of factor 2 is 0. You can draft your answer. Risk premium of factor 2 is equal to 0. This was question number 4.5.6. Next 2 questions that we are going to do is of exponential moving average. Now we have not yet understood what is moving averages, what is simple moving averages, but we are directly going into exponential moving averages because those are the only questions which are asked in examination. But believe me, I'll teach you what are simple moving average, what are exponential moving average, where it is used in trading or stock markets. This is C4.5.7. Let's start it. First, I am going to explain you how to calculate exponential moving average. Start it. And then we'll be going to why it is calculated in this manner, what are simple moving averages, and what is the use in stock market. Closing value of BSE Sensex from 6th to 7th day of the month of the January of the year so and so were as follows. Now, when there was no trading, we are not interested in this particular days. So when there was trading on this day, this day, this day, this day, this day, and this day. So we will be taking only those dates, and let me write down the closing price of that particular day. So this is nothing but 6th, 7th, 6th, 7th, 10, 11, 12, 13, and 17. Let me also write down what was the Sensex at on as on that particular date. 14,522, 14,925, 15,222, 16,000, 16,400, 17,000, and 18,000. Start. Now, what are required is exponential moving average of previous day. Exponential moving average of previous day. Is it alright? For first date, I'll tell you what to take it. But let me first take it. Calculate the exponential moving average of the Sensex during the above period. The 30 days simple moving average of the Sensex can be assumed as 15,000. So simple moving average of 30 days is 15,000. See, EMA can be calculated on continuous basis, but we don't know what is EMA of date 5. Is it all right? So let me take the simple average is nothing but exponential moving average of the previous day. So here EMA of previous day is 15,000. The value of exponent, the smoothing exponent. What is smoothing exponent? I'll explain you once we go to application. Right now understand it is 0.062. And believe me, as we are finding out 30 days exponential moving average, this is 0.062. Normally this exponent will be given in your examination. If it is not given, the smoothing exponent is 2 divided by n plus 1, which is nothing but 2. In this case it is 31, which is not coming exactly 0.062, but it is very near to it. Is it all right? The actual exponent is n divided by n, 2 divided by n plus 1 is nothing but smoothing exponent. In this case, the smoothing exponent or exponent is given, so we will be directly getting 0.062 as a smoothing exponent. Now, what is EMA is very easy. Try to concentrate. I'm writing a full-fledged formula of exponential moving average. Exponential moving average will be is equal to first difference between these two, starting from this, that as the current prices are lesser than the previous day price, it should be negative. Is it correct? So it is closing price minus EMA of previous day. Is it, for EMA I am writing only E. Is it correct? I've got the difference. Then I'll be smoothing it. Is it correct? Multiplied by exponent. But this is only the difference, right? I will add this to previous. Let me do it for first day. Is it correct? 14,522 minus 15,000 is minus 478 multiplied by 0.062, which is smoothing exponent, plus there is a minus, so it will be automatically deducted. EMA of previous day 15,000, 14,970.364. What will be previous day EMA in this case? 14,970.36. Again, same thing will be repeated. Try to concentrate. 14,925 minus 14,970 multiplied by 0.062 plus 14,970.36. It is a 14,967.57. Last time I am calculating and then I will be just writing down the figures, and hope you will understand that. 14,967.57 was previous day EMA. Let me find out current day EMA. 15,222 minus 14,967.57 multiplied by 0.062, that is smoothing effect, plus 14,967.57, which is 14,983.34. Similarly, you can find out of all the days, and if you will find out all the days, this will be your answer. These are the answers. Now, please understand, EMA will be then plotted on the line for this particular number of days. that plotted graph is nothing but, or a line graph is nothing but exponential moving average. Sir, what is this? Believe me, this is last 30 days moving average. Is it alright? It is simple average? No, it is exponential moving average. What does it mean? The last data is given importance. The last data is given more importance as compared to older figures. That is, suppose there's a sixth date. Is it correct? Fifth date is given more importance as compared to first date. Is it correct? So this is the case of exponential moving average. I'll tell you, I'll teach you simple moving average, and then the idea will be absolutely clear. Is it correct? Suppose this is the data, and I'm finding out 3 days simple moving average. See what will be done on 6th day. Try to concentrate. 4th, 5th, and 6th date, closing price average will be taken. So all 3 prices divided by 3 will be taken. That is nothing but 3 days a simple moving average. So on 7th date, 5th, 6th and 7th date closing price will be taken. And then it will be added and divided by 3 will be simple moving average. On 10th date, again last 3 days the trading average closing price will be taken and average will be done. That is nothing but simple moving average. But try to understand, if you are finding out of this date, the average of this 3 date is taken, and importance given to all 3 figures are same as far as simple moving average is concerned. When it is exponential moving average, the previous day figure is given more importance as compared to day before previous day, as compared to older days. Is correct. So this is nothing but exponential moving average. How it is used in stock market, that also I will be explaining you. First, let me once again solve one more question of exponential moving average, so that the calculation of exponential moving average becomes absolutely simple and clear. Question is C 4.5.9. The closing value of BSC from 6 to 17 date on Monday of the year is 2000. So here the trading day are this, Monday, Tuesday, Wednesday, Thursday, and Monday. Compute the exponential moving average during the above period. The 30 days simple moving average can be assumed as 30,000. So only the figures have changed, otherwise it is same. The value of exponent for 30 days is 0.062. How to find out exponent if it is not given? 2 divided by n plus 1 is nothing but exponent. So, provide detailed analysis on the basis of your calculation. Let me write down all the dates. I will be finding out couple of answers, and then I will be just saying it from suggested. 6, 7, 10, 11, 12, 13. 6, 7, 10, 11, 12, 13. 70. The price are 29522, 29925, 30222, 31,000, 31,400, 32,000, 33,000. In absence of information, what should be taken as EMA of previous day in first day? I can take a simple average, which is 30,000. In actual practical life, what should be taken is actual EMA of previous day. Is it correct? In this case, as it is a theoretical question, we need to take some previous day EMA, and that will be taken as 30,000. Is it correct? So current EMA, exponential moving average, is correct, will be nothing but closing price minus EMA of previous day multiplied by exponent plus EMA of previous day. which will be 29522 minus 30,000 multiplied by 0.062 plus 30,000. It is 29,970. This will become previous day EMA 29,970.36. Again this day EMA 29925 minus 29970.36 multiplied by 0.062 plus 29,970.36. It is 29967.5. And similarly, if you will find out all the answers, will be your, this all will be your answers. Believe me, the process remains same. So I have not just calculated and just written from the suggested answers. This will be EMA, will be plotted on the graph and will be useful for technical analysis. Say the graph goes like this of EMA of 30 days. Is it alright? You can say there is an increasing trend and long term you can be bullish in nature. Is it alright? And by whatever interpretation you want to make from this graph, you can make it. Is it alright? Remember, simple average gives importance to all the data equally. When you are finding out exponential moving average, the same thing is done, but the importance to the latest data, say yesterday's Sensex, day before yesterday's Sensex, is given more importance as compared to some 10 days data, 10 days before data, or before 20 days data. The latest figures are given more importance. Is it right? So when you are finding out this EMA, more importance will be given to this figure, comparatively less to this figure, lesser to this, and so on. So this is exponential moving average. So let me practically show you how the EMA works in practical life. See, I'm trying to evaluate Sensex as given in our previous two questions. So this is Sensex. This is a Sensex chart. Or what you can see is a candlestick that we'll be doing in theory of finance. Let me plot a 30 days EMA on this particular graph. Is it alright? So this is an upstock broker program where I normally do my trading. Let me find out in studies moving averages. Here it is. Is it correct? So this is moving averages. Is it correct? How many days moving average I want? I want a 30 days moving average. I want closing price to be taken. Type is I don't want simple moving average. Is it correct? Understand, simple moving average, all last 30 days the trading price will be given equal importance. Exponential moving average, latest price will be given more importance. Is it correct? The red line which you can see, this line, this red line which you can see, is it alright? This red line is nothing but EMA line. See, if I'll click, it is MA of 30 days. Is it alright? So this is plotted on the graph, and see the graph of Sensex. Is it alright? It is going up. So when the people are doing technical analysis, they will remain bullish in nature. Is it alright? Sir, can it be done of 200 days? The answer is yes. Is it alright? Let me again add moving averages and add another line of 200 days. So the close type is exponential moving average, and let me change the color. to black. So are you getting it? The line will be more smoothened. Why? The ups and downs variations will be average for 200 days. Even if the latest price is given more importance, ultimately 200 days prices are average. Again, see the line. If you see the line, this is 200 days exponential moving average will be helpful in practically technical analysis. When people does a technical analysis, and believe me, majority of the people invest the money based upon technical analysis. Less number of people go for fundamental analysis, and very less number of people goes for both the analysis. Correct. So a tool used in technical analysis, exponential moving averages. There were two practical sums that we have solved. Next question that we are going to do is efficient market hypothesis. Normally this portion is asked in theory part. We will be going into detail of t-test efficient market hypothesis as far as theory is concerned. In practical, one question in November 2008 was asked. So we are just solving that particular question. Start. The closing value of the Sensex is given. Let me see the sign whether the Sensex has increased or decreased on a particular date. Start. So this has decreased. Then it has decreased, then it has increased, decreased, increased, 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 3200 increased, 3300 increased, 3450 increased, 3360 decreased, 3290 decreased, 3360 increased, 3340 decreased, 3290 decreased, 3240 decreased, 3140 decreased, 3260 increased. Number of positive change and 1. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It's 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 11. 6, 7, 8, 9, 10, 11. This is 11. And 2, negative sign. 1, 2, 3, 4, 5, 6, 7. It is 8. And 2 is 8. How to find out? Try to understand. Here you will have to learn another formula for finding out mu, that is average. You will have to learn another formula for finding out standard deviation when you are not dealing with numbers but you are dealing with science. You are required to test the weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. What is this? We will be going deep into theory. Let us right now only calculate it. The vectors are given for 5 and 10%, so I can easily find it out. 18%, 18 degree and 20 degree, 5% and 10%, all of them I can easily find out. First, let me give you formula for finding out average when the signs, this type of plus minus sign are involved. Average is 2 n1 n2 divided by n1 plus n2 plus 1. Here it will be 2 into 11 into 8 divided by 11 plus 8 is 19 plus 1. Start. If I solve it, it is 10.26. Standard deviation can be found out by under root 2 n1 n2 into bracket 2 n1 n2 minus n1 minus n2 upon n1 plus n2 n1 plus n2 minus this is whole square. Putting all the values of n1 and n2, I will be getting standard deviation of 2.06. Correct. Now, try to understand. I need to find out the range which gives me 18%, 18 degree of freedom with 5% level of significance. Now the value of that particular is 2.101. The value is 2.101. How to find out is very simple. Try to concentrate. First I'll be doing 10.26 plus 2.06, which is my standard deviation, into 2.101. This is like Z for us. Is it alright? How many standard deviation? You are far from mean. This many standard deviation. Is it alright? This answer will be 10.26 plus 2.06 into 2.101 plus 10.26 is a 14.588. Then it is a 10.26. Instead of plus, here it will be minus 2.06 into 2.10. It is 2.06 into 2.101 minus 10.26. It is 5.9. The Sensex will change 5.9314 to 14.588. This is a range which is in 18% degree of freedom with a 5% level of significance. So there are 95% chances that the data will remain within this particular range. Is it right? So this I have found out with 18 degree of freedom, 5% level of significance. Same way 18 degree of freedom with a 10% level of significance. It will be similarly found out. The point taken will be 1.734. And in that case answer will be 6.688 to 13.83. The data will lie between these two figures, is having 18 degree freedom and 90% chances, that is 10% level of significance, that the data will fall within this particular range. Is it alright? Now t-test, efficient market hypothesis will be going somewhat detailed when we go into theory of efficient market hypothesis. Calculation, it was asked in November 2008. Suppose if it is asked again, we can easily solve it. So we have just done it in practical point. Let us go to last question of this unit, which is 4.5.2. Now this question also I have included in others because this is practically question of security analysis where we have learned something about duration of the bonds. Is it all right? So in this particular question 4.5.2, the investment portfolio of the bank is as follows. So bank is having following investment: These are coupon rates. Face value is 100 per bond, but the purchase price is this. Duration of the bond is given. Face value of total investment is rupees 5 crore. Please understand, not the total investment. Face value of the total investment is 5 crore in each government bond. So let me take this 2006 bond. How much face value you are holding? 5 crore. So how many number of securities you are holding? This is 5 crore divided by 100, which is nothing but 5 lakhs. What is the purchase price? 106.50. Was it alright? So how much total you are holding? 5 lakhs into 106.50, which is nothing but 5.325 crores. Similarly, of 2010 Government of India bond, 2015 Government of India bond, 22 Government of India bond and 32 Government of India bond, the face value I am holding is 5 crore each. So N will be 5 lakhs rupees each. The purchase prices are different. This will be my total investment. Is it correct? 5 lakhs into 10, which is a 5.25 crore. This will be 5 lakhs into 110. It is a 5.5 crore. This is 5.25 crore. This is a 5 lakh into 10. It is 5.05 crore. This is my total investment. The duration of the bond is 3.5, 6.5, 7.5, 8.75 and 30. If I want to find out average duration, try to concentrate. Average duration cannot be found out by simple average. But as here the investment is equal as far as face value is concerned, you should take purchase price. But as far as face value is concerned, only for particularly this particular question, I am taking average, which is simple average. Assume duration is calculated in simple average. You could have calculated it by weighted average, but right here I am doing it by simple average, which is nothing but 3.5 plus 6.5 plus 7.5 plus 8.75 plus 30. It is 39.25 divided by 5. Average duration is 7.85 years. Now, if you have learned the concept of security analysis, we have understood this. As the interest rate increases, the price of a bond, market price of the bond will decrease. With which proportion? With multiple of bond duration. Alright. So the bond duration measures that sensitivity, that how much. But interest and price of the bond are inversely related. Correct. So if it is forecasted, as it is forecasted in 1, interest rate are expected to be lower by 25 basis point. In point number 1, what is forecasted? The interest rate are going to be lower. Your price of the bond will increase. How much? Interest percentage multiplied by duration. Now the price of the bond increases, your portfolio value increases. Is it alright? So higher this figure, more will be your benefit. Higher the figure, more will be your benefit. So if interest rate gets lower, it is beneficial to increase duration. How to increase the average duration? I'll tell you. Dispose of this bond and purchase this bond. Purchase a 2032 bond and dispose of 2006 bond. Purchase more bonds which is having higher duration and remove the bonds which is having lower duration. Number 2. If the interest rate are going to go up by whatever basis point, 75 basis point, the price of the bond is going to fall, lower the figure it is beneficial to you. Is it correct? So what is beneficial? To reduce the duration. So I will sell 2032 bond which is having higher duration, and I will purchase a 2006 bond which is having lower duration. This is not linked to anything but linked to security analysis. So I've kept this particular question in this. This is how we solve this type of question, that is C 4.5.2. By this, we complete the concept of portfolio management.